to report it to the computer. Okay. All right. So let's see. Okay. I think this looks good. Awesome. All right. Well, everybody, I am here with Michael. He is going to talk with us about a really interesting topic, and mostly it's around mortgage liquidity. And so we're going to get into that, but I want to give Michael an opportunity to introduce himself and kind of just tell everybody a little bit about yourself.
Sure. My name is Michael Mesa. I am the branch manager for Land Home Financial here in Pierce County. I've been in this industry for going on 23 years, and in that window, I've weathered quite a few storms and recessions and things of that nature. So it's been an interesting ride, but I've learned some pretty cool things along the way, and hopefully I can kind of share a little bit of that with you on this current interview. So I appreciate it, Ashley. Thank you.
Yeah, absolutely. Thanks for joining me. And yeah, I think this is an interesting topic. I think it's kind of come up quite a bit. At least in the news, and people are kind of, I don't know, not really like pointing to it directly, but it may be a potential problem in the future. So maybe we could sort of like take a step back and kind of talk a little bit about what it means, right? Like, I feel like when people say liquidity crisis, unless you're in the field, you're like, I don't know what you're talking about. So maybe we could sort of start there. Like, what does it basically mean?
Sure. So liquidity really refers to the amount of usable money and or credit per se. And when we hear a liquidity crisis, obviously the terminology is pretty spooky. Like, oh my God, crisis. But the reality is the bond market that we're talking about is from a product standpoint is very different from the stock market. And the majority of people, when we see on the news, we talk about, the stock rising and the S&P and the Dow Jones and stuff. Well, you've got that also in the bond market. And on the stock scenario, you have to remember these companies or organizations are selling stock to raise capital, for their businesses to expand or whatever. On the bond market, it's more of an investor type scenario. I'm looking at buying something that's moderate to low risk, that's going to give me, a relatively steady gain that I know at the end of the term I'm going to make my money, right? So to simplify it, it's kind of like a CD, right? I'm going to give you my money for 4 years. This is what I'm going to get back at the end of the 4 years,
Right.
And the secondary market or the bond market, the product is what we call a mortgage-backed security. Okay, that's the actual product. And with the amount of mortgages that are currently being refinanced and new people buying homes, there is no big pot of money per se, how that works. Each individual lender, whether it's a bank, whether it's a direct lender, that sort of thing, they use what are called warehouse lines. So again, in simplistic terms, it's like having a credit card or a line of credit, okay?
Right.
And you've got, X amount of dollars of that line of credit to be able to use. And whenever a mortgage is funded, that company is using part of their warehouse line to, in the short term, give the money to escrow. That money obviously gets dispersed. And then what happens is they need to reconcile. So reconciliation is nothing more than looking at all the loans that I funded, conventional, FHA, VA, USDA, that sort of thing. And then they bundle them all up into the mortgage-backed security package. And then those are sold on the secondary market to those people who are looking to invest in the bonds. And historically, what's happened is when the stock market goes down, people pull their cash out and they put it into the secondary bond market because it's a little bit safer, at this point.
Right.
And instead, what's happening is people are pulling their money out of the market and then holding it for cash.
Yeah. And,
So you,
that's, I'm gonna just pause you there right now, Michael. Like, that's super clear, right? Like, people, you can see that in like savings rates. Like, people keep a standard savings account, like that interest is like very, very low. Like, banks are not like, hey, keep holding your money. They're like, no, we want you to get rid of it.
yeah, absolutely.
Right? Like, I mean, you can definitely see that in the economy. And this is pretty exciting. I think this is really cool. So sorry, I'll let you keep going.
No, that's a great point too, because I think the we don't really do a good job of kind of showing how the pieces all kind of fit together. And as a consumer, you'll see this in the news, you'll see this on social media, whatever, but there's really no tie-in for how this is going to affect you personally, from a banking scenario, even if you don't have a mortgage. So, this is a great segue into kind of, how that piece works. I think it's pretty important. So the lines of credit are used. We're going to reconcile it. We talked about, the bond market and where that comes from and how it's not traditionally reacting the way that it has in the past. And another key interesting thing that we've discovered on the secondary market is years ago, when somebody bought a bond, they held on to that bond, whether it was a 10-year, 5-year, 30-year, what have you. They held on to it because it was safe, it was predictable, steady income. And they were happy to wait, 5 years, 10 years, 30 years, whatever, for that profit. What's happening now with globalization and the digitizing of money, the advent of things like Bitcoin, people are starting to realize that you don't make your money the typical way that stocks have, where you just get this massive rise and you buy low and sell high. Now the strategy that a lot of people are promoting is make your money on the little blips. And if you diversify yourself doing that, then you'll make a pretty decent rate of return. Well, when you do get an investor on the secondary market that finds the stock that they want to buy, they want to sell their bond, which is pretty normal. The challenge is that a lot of these newer investors want to sell their bonds early, but they want the same gain as if they held on to it for 5 years, 10 years, whatever. And so if you've heard the term negative yield curve, that's where this comes from. And historically in the past, whenever we've seen a negative or an inverted yield curve, it screams recession. But the reason why we've been able to avoid a recession like that has everything to do with Fannie Mae and Freddie Mac agreeing to buy all those mortgage-backed securities, and the stabilization really of people understanding that the money is not coming from the 10-year treasury. It's strictly all about mortgage-backed securities. The 10-year closely mimics it, but now people are understanding that's not the bond. That's not what's going on. So people are getting a little bit more savvy. And so you've got a little bit more activity in the bond market that's independent of what's happening in the stock market, right? So that there's been a change like that. The negative yield curve based upon performance and everything else, the new safeguards that have come in since we've had the meltdown and crisis, the housing bubbles, quote unquote, that people are concerned about, really can't happen the way that it used to. Part of that has to do with the mortgage insurance companies putting their feet down. Fannie Mae and Freddie Mac saying, hey, we're going to unwind, our buying process. And now the market has not been unofficial or artificially repressed. Now it's kind of, taking on its life and kind of standing on its own 2 feet before we had the whole COVID thing. And that promoted a huge run on refinances and, purchases. And so where the liquidity part comes in is that, if you're funding record numbers of mortgages, let's say you're a smaller company and you typically fund, $100 million worth of mortgages per month. That's your norm. Right now you see a spike and you're trying to fund 250 million.
Right.
So you've got 100 million that you're accustomed to. You've got your warehouse lines, right? And every warehouse line has a built-in piece called a bulge. Mm-hmm. So think about it like overdraft protection.
Right.
And so what's happened is a lot of companies have tried to utilize that bulge just to keep track of the extra amount of time and the extra competition on the bond market to get those mortgage-backed securities off their lines. Well, the interesting fact is, where do you suppose these warehouse lines come from?
I have no idea. Where do they come from?
Major banks.
Right.
So
right.
Wells, Chase, B of A,
Right,
all
right,
that sort of thing.
right.
Well, Wells and B of A and Chase and all the other bigger banks, guess what they do? They sell mortgages too.
Of course they do. Right.
Right. And so they're in a little bit more of a conundrum, which creates a problem for all of the other lenders that utilize that bank for their warehouse lines.
Right.
Because the banks are trying to get those mortgage-backed securities off their books. And you've got the individual mortgage companies that are adding stuff to their warehouse line that now the big bank has to wait to get it off their line, right?
Sure.
And so, I'm sorry, go ahead.
So I guess my question is this. So I was kind of under the impression that COVID was creating a problem because there are people that are kind of deferring their mortgage payments.
Mm-hmm.
And it sounds a bit like maybe there's two things happening. Like, now there's a situation where people are trying to refinance.
Mm-hmm.
And there's a bunch of people entering the market right now that want to buy houses.
Mm-hmm.
Right? So that could easily max out like a mortgage company's warehouse line. But in order for them to clear their warehouse line, they have to actually take their bundled mortgages and sell them. And is the problem that they're not able to sell those?
That's
Do you see what I'm saying?
Yeah. No, that's a great question. That's part of the challenge is they're racing against time.
Mm-hmm.
So if I'm steadily using my warehouse line and I'm filling it up and everything else, right? I have the same problem as everyone else that's in the mortgage game that's trying to get rid of their mortgage-backed securities to clear out the warehouse line.
Right.
And this is a great segue. So is there a problem with it or is there a challenge with it? Absolutely, because now you've got banks that have huge numbers of things that need to come off their warehouse line. But now you've also got mortgage companies that are using those warehouse lines that are trying to do the exact same thing. So the competition is amazing. And if you're a bond investor, you're going in for the long haul.
Mm-hmm.
I want to make sure that this investment is going to pay out at the 5-year mark like it's supposed to, the 10-year mark, whatever.
Right.
And so enter the overlay, right?
Yeah.
So what the overlay does is it creates a value proposition to the investor on the secondary market.
Mm-hmm.
So every program has their minimum requirements, right? So the minimum credit score requirement, the minimum down payment amount, the minimum mortgage insurance coverage, right?
Mm-hmm.
But if everybody just did the minimums, where is a competitive advantage for you to buy my mortgage-backed security when I can get the exact same from somewhere else, right?
Right.
So let's use a conventional loan because it's super simple.
Sure.
So the threshold for a conventional loan is 620. That's the absolute minimum as far as the credit score goes. So if I, as a lender, saying, okay, great, I'm just going to do 620. I mean, that's great for people out in the field, right? That might have a few, credit events. That's phenomenal. They can get a mortgage. But now I've hit the bottom and I've got nothing unique about my loans as far as to the investor. Mortgage company B says, okay, the minimum is 620. But the minimum we're going to grant a loan for is 640. And, we're going to put another overlay saying that, the maximum debt to income ratio is 50, but we're going to cap ours to 45. And so then you're going into the secondary market, you're selling the same product, but you've added a couple of extra layers worth of security to the investor to entice them to buy your mortgage-backed securities rather than your competition's. So that in itself is the reason why you might see some fluctuations of, well, I went here and they said I can do this at 620, but then I went here and they said I can't, I need a 640. My debt to income ratio is 47%. And this company said they'll do it, but this one, that's where all of that comes into play.
Yeah.
And it's like the old saying we used to have in the Army when it comes to regulation. You can add to but you can't take away from.
That's right.
And that's really the best way to think about an overlay. Okay.
Right.
And when you've got banks and mortgage companies that are, again, hitting record numbers of applications,
right,
two things happen. We've already discussed. One is I've got all of this money I need to get off my warehouse line because I've got another huge amount that I have to fund and bundle, right? I'm getting more applications than I've ever had before. I'm funding more loans than I ever had before. But there aren't more investors in the secondary market than there were before.
Right. So the investors, okay. So the investors that were initially purchasing these,
correct,
they have basically said, we're not going to. I mean, for a number of reasons. Maybe they feel like, well, we don't believe in the economy enough. These people won't be able to pay their mortgages, so we're not going to get our money back. Right. So has that resulted in mortgage companies? I mean, I think the answer is yes to this, but has it resulted in mortgage companies maybe tightening up their overlays or like changing them? Like, I know that there's more, there's a little bit more strict rules for some groups.
Sure.
And do you think that has been successful in getting investors to say, okay, I'm excited about this. Like, I want to make this purchase.
Right. So the answer, well, there's a couple things. One, have the investors said, no, I'm not going to buy them? That's not entirely the case. We're still coming off of when Fannie Mae and Freddie Mac were buying all of the mortgage-backed securities, so liquidity was not an issue. And so Fannie Mae was the buyer. They're not particular. 620, 640, 660, it's irrelevant.
Right.
As long as you meet the basic requirements. And as a secondary market, I think we got very comfortable with that. Like, oh, I can buy this and no big deal. It just meets their minimum requirements. And there's really no competition. I just have to deliver it to, Fannie Mae or Freddie Mac, and I'll clear up my warehouse line. And that's what I mean by when I said Fannie Mae and Freddie Mac buying all of those mortgage-backed securities in a month artificially repressed the rates in the market because I don't have to worry about getting them off my books.
Right.
So I can attract as many people as I want. I can write as many loans as I want. I know I've got a built-in buyer at the other end. So let's make hay while the sun shines.
Right.
When Fannie Mae and Freddie Mac announced that incrementally they were going to stop buying mortgage-backed securities to give the investors on the secondary market a chance to enter and purchase these bonds, then that was supposed to be, the transition, right? Like the training wheels are coming off. And so now you've got people that, are looking for that security, whether it's, commercial groups, whether it's individuals that, that's how they bankroll other things. Generally, you'd find like hedge funds will pick those up because of the large size of the bundles. But it gave them a chance to come back in the market and quote unquote stimulate the market and still keep it going, on an upward trajectory.
Right.
So then what happened was people figured it out. The Fed stepped in and said, okay, we're going to do this, so forth and so on. The American public was like, oh my God, this is great. 0% interest rate. Well, not particularly the way that it comes across, right?
Sure.
That's all based on short-term credit, but that news created a huge run on mortgage applications. I mean, if I could get a 0% interest rate, man, I'm all over that.
Of course.
You know what I mean? You and I could be best friends in the world, but I'm going to trip you so I can get there first. I mean, that's just, that's how it is. And that's really kind of what we had the J curve when it came to applications and records. And at first it started off with the refinances. People wanted to lower their rate. They didn't care about performance. They just wanted to lower their rate.
Right.
And that started this trend. Well, now when you're doing refinances, what comes out of those is, oh, I want to buy an investment property, or, now is the time for me to sell, and then I want to buy another property. And kind of going back a little bit to the negative yield curve, and everybody assuming that the housing bubble was going to hit us again. What really happened was in certain pockets on a microeconomic level, certain pockets, buyers were able to purchase for a short window of time a pretty flat level of appreciation. In certain isolated situations, yeah, houses may have dropped value slightly, but not enough to make a blip on the radar.
Right.
So it kind of stabilized the real estate market to not have those artificially spectacular gains, right?
Right.
So that was great news for everybody. But then what happened was COVID hit.
Right.
And, people were losing their jobs, the overlays that you talked about as far as being a little bit more restrictive, that added a new element to the game.
Right.
So what's happening is I'm in the middle of a refinance transaction, or I'm in the middle of a purchase transaction, and our customer gets notice from their HR department, hey, you're being furloughed.
Right.
Okay, what can we do? Absolutely nothing, because now they don't meet the qualifications of the program.
Well, yeah, just the basic.
Right, absolutely. Right. It's not their fault.
No.
And it's not like it's something that we can waive. So at the end of the day, there's an impasse, right? There's nothing we can do, until they come off a furlough or they get reinstated. But even then, there's a timeline. And the concern is, well, what happens if rates go up in that timeline?
Sure.
So then enter the Rental Protection Act and the forbearance scenario.
Mm-hmm.
So now what's happening on the real estate side of things, and I'm sure that you're seeing it too, is you've got people who have managed to build a pretty impressive real estate portfolio, and that's how they fund their retirement, is on the rents and things like that. If I cannot evict somebody for not paying their rent, I am carrying the full load of what my monthly obligations are for the mortgage.
Right.
If they are not paying me rent, but they're protected, then there's every month I'm going further and further into the red.
Right.
Now, and correct me if I'm wrong, now on a real estate side, that's going to affect their cap rate.
Absolutely.
Which means that their property is of lesser value, quote unquote, to an investor, should they choose to buy it. Am I correct on that?
Yeah, like if they sold it.
Right.
Yeah, 100%. Like I think if they had to, for full disclosure, the tenant's not paying rent. that's tough.
Absolutely. Yeah, brutal. So then what happens to portfolios, right? So now you've got the rise again of what we call the non-QM loans, things that kind of fall outside the government guidelines. So now this is the great opportunity for the flippers to come into the market, rescue these people.
Right.
But at that point, the rates are not favorable. The costs are high. And the risk is you have no idea when they're going to repeal this scenario of, hey, I need to clear out my investment property because I need to start making some money. And so if you take that, now you're paying, and your hold cost, quote unquote, goes up even more astronomically.
All right. Do you know, just really quick, do you know if the folks that have the properties as investment properties are eligible to defer that mortgage?
Yeah, so the deferment process really depends on the lender.
Sure.
Okay? For us on the back end, as the lender goes, and this is another reason why it's creating a liquidity issue, is we as a company have to pay up to 4 months of payments to the mortgage-backed security investor, whether we're getting it or not. So imagine this entire portfolio of mortgage-backed securities that we as the individual lenders who lent on them have to pay to whoever it is bought the security.
Right.
Okay. So to the tune of, and I won't mention their names, but to the tune of several prominent companies are literally spending hundreds of millions of dollars per month because their servicing portfolio is so wide across the nation per month. And they have to do it for 4 months before they can step in and Fannie Mae, takes over that responsibility. Circling back around, I've got more applications than I know what to do with. My warehouse line is maxed. I can't use the bulge scenario or the overdraft protection. And I still have to make the payments to the investor for 4 months on each individual loan where they're not making the payments. Okay. And every day, more and more people are going in for forbearance. So it's almost impossible for me as a lender to keep track of anything. I mean, that's realistically going to start going like this, until all of this is over, which again creates a little bit more liquidity issues in the market. Because if I'm a bond investor, I'm only guaranteed to get 4 months worth of payments. That's it.
Right.
And depending on the overlay of the loan that I bought and everything else,
Sure.
it becomes a little bit riskier. And the secondary market, like I said, is basically controlled by hedge fund managers. I mean, to just, break it down to the simplicity.
Right.
If you're hedging, what's a good bet?
Right. Right.
And mortgage rates are reflected by that.
Yeah. So I think I have two questions about that.
Sure.
So are the investors that have the bond, if they get those 4 months of payments, let's say, are they able to like sell it? Like, can they just be like, I want to get rid of this?
Again, I'm not like super privy because I don't buy things on the secondary market, but obviously they're tradable. But you have to look at it from an economic standpoint. Okay, am I losing money, or do I have a bond that's rated at 5% where the typical is 3%? Do I want to hold on to this and weather the storm? What overlays did it come through? What's the past performance of their default rate? I mean, these are all things that the hedge manager really has to take into consideration. And, now you've got the servicing piece of it. Maybe I don't sell it per se, but I'm going to shift the servicing portfolio part of it over to somebody else because I need to cut my costs. I need to streamline what's going on. This person's responsible for collecting it. They can deal with the challenges. I mean, yeah, it still affects me with the bond scenario. I got to pay out 4 months, but I'm strategically putting my human capital to work in a place where either A, I can give support in doing more loans, or B, we can focus on, how we're going to weather this storm. How are we going to stem the flow of applications but still get good service? How do we keep our purchase times down from 60 days when they used to be, 21 to 30 days, depending on what's going on? So the short story long, can they sell it? Probably. Is it going to be worth doing? That's going to be up to the individual, who has the mortgage-backed securities.
Of course, yeah. They have to kind of do their own math. So,
Absolutely.
I mean, it seems to me, I think so mortgage rates are lower.
Mm-hmm.
I mean, does that excite investors? I mean, because that's like basically like some portion of that is like their yield.
Sure.
Like, it seems like it's pretty like, pretty low.
Yeah. I mean, if you look at any investment, right, my rate of return is not going to be, as good as, back in the late 90s when we were still coming off of, 12%.
Yeah.
Or if you look at the average interest rate over time, roughly 7.5% to 8%, you're not going to see those gains. But what you can do is assemble a huge bundle of mortgage-backed securities that give you the best opportunity to get paid out and the lowest default rate. So as an investor, am I excited? Absolutely. Am I looking at the bond for those safe long-term gains? Absolutely not. But I can build a pretty good portfolio that's going to be solid. That's over month after month after month. I'm going to get performance. So if I ever do need to liquidate any of that, I've got a viable thing that somebody's going to want to buy, especially if the market gets a little bit volatile.
Right.
So I'm not necessarily going to make a lot of money, but my risk of losing money in the bond market is somewhat mitigated.
Is low.
Mm-hmm.
So I guess it kind of leads me to like, and this is just kind of free for all. You can kind of sort of put your influence on this and sort of tell me what you think is going to happen. But I mean, I think that this whole COVID crisis is lasting a bit longer than anybody expected.
Yeah.
Right? I mean, people thought it was going to just be like maybe a month or a couple of weeks or something like that. This is going to like kind of play itself out. Could be like a year.
Mm-hmm.
So, I mean, is it possible that, a liquidity crisis means that basically you would not be able to make a new mortgage, right? Like
in theory, yeah.
Right? Like in theory, like the idea is that, look, I can't write mortgages anymore.
Right.
I think obviously if we had to go down that like worst case scenario, that would suck a lot, but not good. Yeah. But what do you think? is going to happen? What do you think is the likely scenario? Like, are we going to go down that road? And yeah.
I don't believe so. And the reason for that is, I mean, obviously Fannie Mae and Freddie Mac stepped in at a time when we were at the biggest crisis, from a housing scenario. Foreclosures were at record highs. There was a lot of, loan fraud and everything else going on. And, I'm not saying that Fannie Mae and Freddie Mac, just rode in with their capes blowing in the breeze. But there was an alternative to bring the market back to normal as much as possible over a period of time. And, if you've ever seen that movie, Too Big to Fail, the Fed has absolutely no influence over banking or whatsoever, but they can be a partner to figure out how to inject, cash into said banks for them to, continue to extend credit. Okay, so you've got Fannie Mae and Freddie Mac, which, again, Fannie Mae's already re-entered the market saying, okay, we're going to start buying mortgage-backed securities again. You've got the Fed that have dropped the rates so ridiculously low that the idea is to all of us consumers, if credit is more readily available, then I'm most likely going to refinance a high interest rate credit card, student loan debt, cars that are a depreciating asset. So I'm going to reconsolidate. And now, as a bank or lender, I'm getting more interest money coming back in, while at the same time, from an economic standpoint, the average consumer is lowering their debt strategically. So for the brick and mortars, there is kind of a way to kind of keep the wolves off the door, because they have a little bit more breathing room to put things in different buckets. For us, the direct lenders, the best way to handle things, and you've seen this, I'm sure, is to continuously put overlays and then just point blank tell people, listen, the time to close is 45 days, 60 days, 90 days. Mm-hmm. And what that does is it slows the applications coming in.
Right.
But then also it gives you a 30-day extension to get the mortgages off your warehouse line. And that's why you're seeing such a huge delay in time. It's not so much that the lenders can't keep up with the volume, which, obviously it's going to be a challenge anytime you double it. But the real issue is how do I get this off my warehouse line to fund this and this and this? Well, if I've got 60 months to solve a 30-month problem, chances are very good that I can maintain that 30% credit to non-credit usage and stuff like that.
Right.
Warehouse lines are being canceled because the banks just can't hold them anymore. They just can't because they've got their own liquidity problems. And depending on how you're set up, like for us, we service 90% of the loans that we write. So we don't necessarily have the pressure that another company would have because we're going to keep it. Okay. And right now, what you're seeing is an even larger number of loans, as soon as they're off the warehouse lines, are instantly being sold. Because I got to find a way to bring cash back into my organization. I've hired more people, everything else. My costs have gone up, cost benefit analysis. If I keep it for 60 days, can I get rid of it? Yep. But what's the opportunity cost versus, all right, let me write a good loan. And let me just, just keep getting rid of them so I can keep my line at a certain place. Mm-hmm. And knowing that most banks are not giving additional credit lines or warehouse lines.
Right.
So you've got to learn how to do more with the same. Or in some cases, if your line has been canceled, more with less.
More with less, right. So I guess since I focus mostly on residential real estate, I guess my question is how is this going to impact the everyday person if they want to get a mortgage? I think you've hit on this a little bit, maybe closing times might be longer, but is it going to be would it limit their ability to get a mortgage?
Yes. Okay. For the reasons that it's not just the lenders per se, that are dropping in their overlays, right?
Right.
We all know cash is hard to come by. I mean, that's the whole reason why you've got the down payment assistance programs.
Right.
That's why you've got, the first time home buyer, 3% down conventional, that sort of thing. Mortgage insurance companies, private mortgage insurance companies, right, on the conventional side, they're the ones taking the risk. They're the ones who are guaranteeing the lender that should a foreclosure happen, you're going to be guaranteed, 25% of the loan amount, right? Well, these are private companies. I mean, I don't know where it came from, but a lot of people seem to think that a conventional loan is a government loan. They seem to think that Fannie Mae or Freddie Mac are government entities, and nothing could be further than the truth. So circle back around, lenders got all their criteria, overlays, that sort of thing. But now the mortgage insurance has to guarantee that lender in case of default, 25%. Record numbers of mortgages, massive increase in risk to the private mortgage insurance companies. So now the mortgage insurance companies are going to say, 8 months ago, where one loan would their monthly mortgage insurance rate would be $250. Now I'm seeing $500, maybe a little bit more, because they have to mitigate their risks.
Right.
So in addition to the overlays and the timeline for conventional loans, now you've got the private mortgage insurance people that are saying, hey, look, yeah, we're doing all this stuff, but 25% is a lot of money. And so their way to minimize their risk is just simply charging more. And so the average person walking in the door, I've got 3% down, I've got phenomenal credit, my debt to income ratio is well below the standard, and I want to buy a $350,000 house. My payment should be close to, whatever. But now it's going to go incrementally more because of the advent of mortgage insurance.
Sure.
And, and as a lender, there's certain ways that we can try to mitigate that. But again, we don't control the mortgage insurance rate on conventionals. Right. We don't control the mortgage insurance rate or the MIP on FHA.
Right.
So, as a lender, the only thing I can do is shop the individual mortgage insurance companies to find out, who's going to give me the best rate that I can, turn around and pass on to my customer.
Right.
And I can tell you right now, my loan officers are running into the same scenario here where all of a sudden your debt to income ratio is phenomenal. But then you add that higher mortgage insurance and now you can't qualify for the house.
Yeah. Right. So like, even though rates are lower, which is awesome for monthly payment, you might, if you're under 20%, be slapped with more on the mortgage insurance side.
Yeah, and
it's interesting.
For old-timers like me, you have to really kind of dip into your bag of tricks and figure out, kind of how to mitigate it. There's things called lender-paid mortgage insurance, which is an option for a lot of people. There's what we call split mortgage insurance, which can sometimes mitigate the cost. But at the end of the day, all of this is really going to trickle down to the individual person looking to purchase a property.
Sure.
And so one of the best things that can happen is, obviously we all know about credit score. We all know about, down payment amounts and that sort of thing. But there are a couple of different ways that you can completely legally, almost instantly within a 3-week window, improve your credit score.
Right.
That ultimately makes a difference in what your mortgage insurance premium rate is going to be.
Sure.
Debt to income ratios and things like that, those are all going to come into play. So now I think what the general public is starting to finally understand is that rate, while good, don't get me wrong, is not what you should be focusing on. It's all about performance. And where is that going to leave you when this loan funds?
Right.
What's going to happen with you and your family, and I say this a lot to my clients when I look at a loan application, particularly when I see that, let's say that somebody has a 14-year-old and their savings account is 25 cents. And I look at their bank accounts and it's all pass-through income. Right. And they've got no money in their 401k. Well, if you're like me as a parent, you know that your child's moving towards the age where they're going to start driving. Where's the money going to come from to buy the car?
Right.
Where's the money going to come from for the maintenance, the insurance, that sort of thing? So again, I can give you a loan probably, but you're going to be house rich, cash poor,
Yeah.
That bleeds over into your side of things, where either now you're going to get people who are going to have a short sale,
Right.
or just a full blown foreclosure, or sellers that overprice their houses trying to capitalize on the spike just to mitigate their losses.
Sure. Sure.
Does that make sense?
It does make sense. So do you think, I mean, it sounds a bit like the people that have great credit and have, 20%, 30% down on their house probably aren't going to be affected as much.
Yeah.
I mean, I think unless they're like, perhaps if they get into like high balance or jumbo loans, I mean, they might run into some things, but I mean, it sort of sounds like largely if you've got a nice down payment and great credit, probably not going to have a huge issue, but you could run into some problems if you're going to be doing less than the 20% down and, maybe don't have like super stellar credit. Right.
Yeah.
Okay.
Yeah. And it's all, and this is not changed at all, but it's all based on risk and risk.
Sure. Sure.
And, just like when you get a job, right? The company is taking a huge risk on, you staying there, you performing, that sort of thing. Right. Well, but you as the individual are also taking a huge risk that your job is safe, the company is going to be, in place, and this, you can continue to feed your family. It's roughly the same dynamic when it comes to mortgages, right? Because my name's on this. I wrote this and said, great people, everything's going to be fine. But the consumer doesn't necessarily understand the risk that they're taking when they sign their name at the closing table, and they're obligated to this loan for, 15, 20, 30 years.
Right.
So, I circle back around to performance.
Sure.
Don't get me wrong, rate is important, but not as important as your ability to make adjustments in your life should you have some unfortunate things happen. And this is the example that I use for a lot of people to kind of put it in perspective. If you were to come to me, Ashley, and say, Michael, I want a mortgage. Right. And I said, phenomenal, right? I'm super lender with my keep blowing in the wind, and I can take care of you, right? And I say to you, Ashley, how would you feel? It's a secret, but how would you feel if I could get you a 1% interest rate? Right?
Yeah, people would be like, yay.
Absolutely. I mean, I'd have a monument in your front yard, right?
Yeah, right.
The reality is the way the mortgage system works, and we talked about this with mortgage-backed securities. In order for me to give you a rate with no cost at 1%, which is lower than the average, for an investor to bite on that, I'm going to have to amortize your loan over 2 years. You're on a $350,000 loan. Your payments are going to be, $80,000 a month.
Right.
But for 28 days, you can tell everybody at work that you got a 1% interest rate.
Right.
Okay. Now, on the flip side of that, how would you feel if I said, Ashley, listen, I can get you a rate. This is a phenomenal deal. And your rate's going to be 12%.
Probably sad.
You would probably pick up the first heavy thing you could find and take a swing, right?
Right.
Okay? But what if I told you at a 12% interest rate, I can amortize your loan over 200 years, and your minimum payment is $75 a month.
Right.
Okay. But the rate is terrible versus the rate is good. Performance is better.
Right.
Because at a 12% interest rate, my minimum requirement to cover the interest is so small.
Right.
That if I made a payment, a normal 30-year fixed rate payment, how fast would I start paying down the balance?
Sure.
So lenders are really in a position where we have a greater opportunity, I think, to educate those people who are looking to purchase homes and looking for a mortgage, and really get them to see the long term. Now the industry, the media, things of that nature, obviously they can't go into that level of detail in a 15-second commercial about I'm so great. But that's where we on the back end come in and say, listen, this type of behavior is what led to the bubble bursting and everything else. So you really need to think about, what you're doing here. And a lot of times I end up having a conversation based on microeconomics. which is weird because, you would never think that. But it's all about opportunity cost, right?
Right.
So you can defer your debt, you can do this, or you can spend all of this money to buy points to get the lower interest rate possible. But what's your break-even point? How long is it going to take you to recoup that money?
Right.
Is there a better use of that money to create a separate wealth account outside of the equity you're building in your home to hedge your bets in case something happens? See, these are the conversations that need to be had with individuals. And because of the panic of a bubble or not understanding what's happening, now consumers have a better mindset of, I need to figure this out because I'm hearing all of this information. Yeah. So the spike in overlays and things like that, and COVID really kind of running rampant for as long as it has really gotten people to really take a look at their financial situations, which makes it easier for us to have that long-term conversation and get people to understand the house is what you're investing in, right? The mortgage, flat out, is debt. That's what it is.
Right.
But as economics will show you, there is a way to literally spend your way out of debt. Right. And that's where it comes down to being smart with your money. That's where performance is key. And as long as there's the threat of a liquidity issue, right, or anything happening, if you've created that separate wealth account outside of your house, you're probably going to be in a better position than those people that are just moving in the traditional manner.
Right.
Does that make sense? I know I threw a lot at you real quick.
You did. Okay. Well, cool. I think that's really interesting. Yeah, I think this is really, really helpful. And I think, I hope people find it to be interesting. I don't know. I think it's a very interesting topic. I don't know, like kind of like, there's always like this sort of like small picture, like, oh, helping someone find a house. But I think the big picture is like, okay, what's going on?
Well, and I think, one of the things that I enjoy about our conversations and watching what you do for your clients is you're very in tune to the fact that you don't sell houses. Houses sell houses.
Right.
What you do is develop the best, and correct me if I'm wrong, but the best offering strategy for those people who are looking to acquire real property.
Right.
So on the back end, if the lender does a great job at the mortgage strategy, you can have a lot more confidence in your offering strategy to make sure that they're not paying too much for the house. It's not going to fall down around their ears and stuff.
Right.
And I think a lot of people who are looking to purchase a house are starting to understand that because they're hearing, oh my gosh, this house went for $150,000 over, and it was only in the market for 16 seconds.
Right.
And my agent's telling me I have to pay $3 million for a 250. I'm exaggerating, but I really appreciate the fact that you're having those that level of conversation with people, because a lot of people on your side of the table, and frankly, and mine too, don't understand that everything we do leaves a fingerprint.
Right.
Not just on our client, but everybody in their local neighborhood. Because if we get it wrong, we're affecting everybody's values.
Right.
And so, the way that you go about running your business, the way that you understand the long-term impacts, I think are what's needed in your market. Conversations like this need to be had. And on a micro level, when you and I are sitting down talking to people, I'm really hoping that what we're conveying as people on the ground in the industry can kind of dispel some of those myths, and quite frankly, kind of abate some of that fear that's caused by all of this information that's just coming at us at such a ridiculously high rate that we just can't process it.
Right.
Adding the fact that we don't know what to believe. We don't know where to get this information, that sort of thing. So I think that's phenomenal. And I think really with the COVID, what's going to start happening is from the real estate agent side of things, consumers are going to start wanting more. They want to know, more about real property. How does it affect them? How do I make sure I'm not paying too much? How do I, when you're looking at people who want to liquidate their real property, You know, how do I make sure that I'm tapping on value?
Right.
You know, and being willing to have those fierce conversations about what is, but also having the knowledge to be able to defer to saying here. So, you know, conversations like this are very much needed. And I echo that. I really hope that people find some value in this, because the world's changing every day.
It is fast too.
You know, but the one thing that changes is simply this. Real estate is one of those things that will always be the topic of everybody's mind.
Right.
For two reasons. One, we obviously need a place to live. And number two, I think it's very apparent that despite technology, real estate, when it's gone, they can't make anymore. So, you know, it's something that, you know, if we're going to try to get our little piece, then we need to make sure that what we're doing is going to be right for us financially, but then also the long term to make sure we don't negatively impact our family.
Right. Yep, I agree. Well, awesome. Well, thank you so much.
Sure, it's my pleasure.
Really appreciate it. Yeah. Well, I'm going to sign off here. If you guys have any questions, please put them down in comments, and we'll get your questions answered. Other than that, see you again soon.
Awesome. Thank you.